Hi CA students, let's revise CA final AFM Advanced Capital Budgeting Decisions. Practical question 19. KLM Limited requires 15 lakh for a new project. The project life is 3 years and the salvage value is nil. Depreciation is given as 5 lakh per annum. Given below are projected revenues and cost excluding depreciation and ignoring inflation. So they've given revenue and cost for 3 years, which is excluding depreciation only. They are telling the costs are excluding depreciation, and tax rate is given. So we have to adjust. We have to take the tax benefit on depreciation, and since these cash flows are in real terms and not in nominal terms, as ignoring inflation. Applicable tax rate is given as 35% and assume nominal cost of capital to be 14% after tax. So cost of capital is 14%, which they have told it is nominal. So we have to convert this cash flows into nominal terms and then use this discount rate to arrive at the NPV, and then we will check the feasibility of the project. Even the requirement of the question is about NPV, so we need to convert this cash flows into nominal terms and then find out the NPV. Inflation rates are given for inflating this revenues and cost. So revenue separate percentage for each year is given and cost also separate percentage for each is given. This is same as one illustration which we did in this chapter. So and present value factor at 14% for 3 years, which they have already given, so we should use the same numbers, and show amount to the nearest rupee in calculations. So in all the calculations we should not use any decimals, as the question itself clearly states to round it off to the nearest rupees. Now calculating NPV. Now going to the solutions. First we have to convert all the cash flows into nominal terms to find the NPV. Revenue, so the basic model will be revenue minus cost. We will get earnings before interest and tax. On this we will reduce taxes, then we will get net profit after tax, and then we will add tax benefit on depreciation, and then we will arrive at the nominal cash flow. This nominal cash flow will adjust with the discount factor yearly, then we will reduce it with the initial investment to get the NPV. So now this revenue is in real terms, we have to adjust it with the inflation. Same case with cost also. So the year 1 revenue is 10 lakhs, multiplying with the inflation rate for first year 9%, adding 9%, it will become 10 lakh 19,000, and second year revenue is 13 lakh. So as previously discussed, so these are the projections which we are making when we are checking the feasibility of the project, let's say today, and when we are projecting a second year cash flow now, so it has to be adjusted with first year inflation also, then it has to go through the second year inflation. So this 13 lakhs has to be first adjusted with first year inflation, which is 9%, then again second year inflation 8%, then coming up with the third year revenue. Same case goes here. Third year revenue is the projection as on today when I am checking the feasibility of the project, and as how we are adjusting the discount rate, same way goes with inflation also, but inflation differs every year. So 14 lakh into first year inflation of 9%, then second year inflation of 8%, then third year inflation of 6%, wherein this inflation rate has to be added up. So 14 lakhs plus 9% plus 8% plus 6% in calculator also works, or while solving 14 lakhs into 1.09 into 1.08 into 1.06 will give a value of 17 lakh 46,965 rounded up to nearest rupees. Same case goes with cost also. How we did revenue, same with cost. So 5 lakh, 6 lakh and 6 lakh 50, 5 lakh into 10, then 6 lakh into 10, 6 lakh plus 10 plus 9, then 6 lakh 50 plus 10 plus 10 plus 9 plus 7 percentages. We will get the respective inflation adjusted nominal cash flows, nominal costs. Now tax benefit on depreciation. Since depreciation they've already given, we will multiply with the tax rate 35% and we will get the value of 1,75,000. As previously discussed, depreciation is on historic basis, so inflation will not affect depreciation. So we have to directly adjust the tax rate. Net profit after tax will be revenue minus cost. We will get net profit, then tax 35%. If we reduce, we will get profit after tax. Then we have to add tax benefit on depreciation. We will get the total cash inflows, which is inflation adjusted nominal cash inflows. And cost of capital is also inflation adjusted, as they have given nominal cash flow, nominal cost of capital 14%. Now multiplying with the present value factor with 14 at 14%, we will get the present value cash flows, which is added up to 15,19,965, and the cost of the project is 15 lakh, reducing it, which we are arriving at a NPV of 19,965 as per the requirement. Thank you.